All right, let's jump right into this explainer and absolutely dissect Exxon Mobil's financial DNA. If you've been wondering whether this giant energy titan actually deserves a spot in your portfolio, well, you are definitely in the right place. Today, we're putting our value investor hats on. We're going to completely ignore the daily stock charts and look deep under the hood of the actual business to figure out what it's truly worth.
We're anchoring our whole investigation today on one very specific number, $155.29 a share. Now, that's the current market price, sure. But as any seasoned value investor knows, price is just what you pay, right? Value is what you actually get. So our entire mission right now is to figure out if the underlying business genuinely justifies that kind of a hefty price tag, or if maybe the broader market is just getting swept up in a wave of optimism.
So here's how we're going to break it all down. Number 1, the energy Goliath's moat. 2, financials, cash and cyclicality. 3, calculating intrinsic value. 4, weighing the major risks. And finally, number 5, the final investment verdict.
All right, Section 1, the energy Goliath's moat, understanding Exxon's competitive advantage.
Look, in the hydrocarbon business, scale is literally everything. And Exxon, they have a massive, almost impenetrable competitive moat. I mean, they aren't just out there drilling for oil. They control incredibly vast global infrastructure networks, huge low-cost reserves, and they have some serious deep expertise in liquefied natural gas, or LNG. And because of their integrated model, they do it all. They extract the oil upstream and then they refine it downstream into everyday fuels and chemicals. Smaller competitors just can't easily replicate that kind of scale or operational efficiency. It's like a giant, perfectly balanced machine. So when weak refining margins hit the industry downstream, Exxon's upstream profits can actually step in and offset the damage and vice versa. It is incredibly durable.
Moving right along to Section 2, financials, cash and cyclicality. Let's peek under the financial hood.
Now, Exxon is obviously a phenomenal business, but make no mistake, they operate in a ruthless, highly cyclical industry. Just look at the drop in these numbers. Back in 2022, fueled by soaring commodity prices, Exxon pulled in a genuinely astonishing $55.7 billion in net income. But if we look at the trailing 12 months, that number has normalized way down to $25.3 billion. Guys, that's a 45.8% drop. It perfectly demonstrates just how incredibly sensitive their earnings are to commodity cycles. Their whole business model is deeply, fundamentally tied to global energy prices, which means as an investor, you have to brace yourself for some serious, inevitable peaks and valleys.
But here is exactly why value investors can still sleep like babies at night, even during those massive earnings drops. Even after coming all the way down from those crazy 2022 highs, Exxon still generated a massive $18.8 billion in free cash flow. Combine that giant pile of cash with a deeply conservative debt-to-equity ratio of just 18.3%, and wow, you have an incredibly resilient supermajor on your hands. This kind of raw cash generation and super low leverage, it's the exact financial armor a company needs to survive an oil market crash. It basically ensures they can keep right on funding their dividends and buying back stock without breaking a sweat, even when oil prices take a nosedive.
Okay, let's get to the fun part. Section 3, calculating intrinsic value. What is Exxon really worth?
To find the undeniable ground-level truth of what Exxon is actually worth, we're going to combine two different valuation methods. First up, we use a discounted cash flow model. So factoring in that massive $18.8 billion in cash flow and applying a nice conservative growth rate, we get an intrinsic value of about $118 per share. Then, if we use a multiple earnings value approach based on normalized earnings, we land at about $132. Blending those two numbers together gives us a really solid, conservative baseline intrinsic value of roughly $125 per share.
And honestly, this brings us to a massive aha moment. Remember that market price we anchored on at the very beginning of the explainer, $155? Well, at that current market price, Exxon actually offers a negative 24% margin of safety. That's right, negative. For any disciplined value investor out there, that is a giant, glaring red flag. To put it simply, the stock is currently trading materially above its conservative intrinsic value. Basically, the market right now is pricing in structurally higher oil profitability and practically perfect, sustained energy demand forever. They are leaving absolutely no margin for error.
Which leads us to Section 4, weighing the major risks, preparing for different futures.
You see, a really smart value investor always prepares for different futures. You don't just bank on one outcome. We've mapped out 3 distinct paths here. In a bull case, where we see sustained tight energy markets and just booming demand for LNG, sure, the intrinsic value could stretch all the way up to $180. Our base case, as we just calculated, sits right at $125. But if a bear case hits, say oil falls below $60 a barrel and a global recession really squeezes those refining margins, well, that intrinsic value drags all the way down to a painful $85 a share.
The thing is, the market currently has Exxon priced as this unstoppable structural winner, but they might be seriously underestimating some of those bear case triggers. And the major risks we're looking at aren't just limited to a simple oil price collapse. We've got to factor in the very real threat of strict carbon taxes, unexpected geopolitical disruptions, and tightening ESG-related capital restrictions. Now, is a permanent loss of your capital likely? Probably not, especially with Exxon's fortress of a balance sheet. But make no mistake, those risks can severely compress the stock's multiple over time.
All right, let's wrap this up with Section 5, the final investment verdict. Buy, hold, or sell.
So, pulling it all together, the big takeaway is pretty clear. Exxon is undoubtedly a world-class, top-tier business. Bankruptcy risk? Basically zero. Management is returning cash to shareholders super efficiently, and they remain just an absolutely dominant energy franchise. But, as a disciplined value investor, you are quite simply paying way too much for it today at $155. If you already hold the stock in your portfolio, it's a very solid hold. You can just sit back, keep collecting that wonderfully stable dividend, and enjoy the company's long-term resilience. But, what about for new buyers wanting to jump in right now? Well, the ultimate verdict for you is to wait.
To really understand exactly what you're waiting for, let's map out some desired returns. Let's say your goal is a solid 9% compound annual growth rate over a pretty long 16-year holding period. To get that, you'd really need an entry price down closer to $102. Even if you're looking at a much shorter 5-year hold, you'd still want to buy in somewhere around $128. Ultimately, your absolute ideal buy zone is going to be significantly below $105. And honestly, that is a long way down from today's massive premium of $155.
Look, the harsh reality of cyclical energy stocks is that the absolute best buying opportunities only really emerge during an oil market panic or a full-blown global recession. That's when the broader market inevitably panics and overreacts to the downside, giving you the discount you need. Which leaves us with this final, critical question for your own investing strategy. Do you actually have the patience to sit on your hands, tune out the noise, and wait for that perfect pitch?